right, everybody, we are looking at what is called monetary policy. And I gotta say, it used to be a lot more simple, right? There were two major things that governments could do. They could engage in fiscal policy, which is what we just looked at, where it involves government spending and taxes. Those are the two, the teeter-totter, both sides of the weigh scale. And monetary policy, which was, as we'll come to see, adjusting interest rates and the money supply to increase or decrease spending. So now, though, monetary policy is undergoing challenges from what's called like the left of economic thinking. And forget about that whole idea of left. It's just a different way of looking at it. And a lot of governments, including our own, that is the policy they are pursuing. And this is where you, as an economics student, you are starting to get the advantage over other people of understanding the concepts behind what's going on in the economy. When you go on Twitter, when something happens, you have no end of opinions of why something's happening or what the government should do. And for the most part, most of those people haven't got a clue on what they're talking about because they don't understand anything beyond the basic fundamentals of economic theory. And even then, a lot of them don't understand what economic theory is, let alone being able to spell economic. But for the most part, you have a lot of half-educated opinions there, and that's very dangerous, So I think I've said before, in terms of like finance is extremely dangerous because you can learn just enough to lose all your money, right? Being an expert at finance is very difficult because there are a lot of factors to go into it. And we're seeing with economics, it's the same idea. So I'm going to start first with this building, which of course is the headquarters of the Flat Earther Illuminati in Canada. They are bent on world domination through fake news, and I think it's time that we stop playing around in this class, and everybody needs to pay attention. Wake up, sheeple. Okay, no, obviously this is not that, because that's wackadoodle nonsense. This is the Bank of Canada. The Bank of Canada is, it might as well be the Illuminati, because most people are like, I don't know what that place does. They think it's a bank that people walk into, and I don't know what they think, actually. Some people think it's an actual bank. You, hopefully, this morning were doing your investigation on the different types of financial institutions. Those institutions are controlled by or overseen by the Bank of Canada, right? So, well, of course it's right. I just told you it's right. No. But that's this part. So the financial system. So things like banks and the operation of banks in Canada is under the oversight of the Bank of Canada. Monetary policy, that's what we're looking at for the most part today. Currency, this is the control over, printing notes, which, yes, the mint prints notes, the bank notes, but the Bank of Canada is in charge of what they look like and all that kind of stuff, producing them, all that stuff. So the mint works with the Bank of Canada, for the Bank of Canada. And then the funds management, that is the part where the Bank of Canada funds the government, Bank of Canada funds banks, all that kind of stuff. So, in the United States, the Bank of Canada, the equivalent of the Bank of Canada, so the equivalent in the States, they refer to as the Fed. And that would be the most, what am I saying? Yeah, that's the most equivalent. The Fed is the federal, actually, what is it called? Okay, I shouldn't have brought that up because right now I can't remember because I always call it the Fed too. Anyway, it's the same idea. Central Bank of the United States, that's what it is. So this is the Central Bank of Canada. So one of the main things that the Bank of Canada does is it controls the key overnight interest rate. And this is critical to the economy because this gives, so the interest rate that we are, I don't know, why did I just draw that? Look at that, a percentage sign. We are used to looking at, okay, I'll put interest rate. What are the ones we look at? We look at what? No, we don't. I thought it looked like nutrition was going to come out. We look at things like mortgage rates, loan rates, same idea, but line of credit, student loans. All of these things are dependent upon the overnight interest rate. So the overnight interest rate is the rate at which the banks can borrow from the Bank of Canada. That does not mean that, so currently 0.25 or 0.25% is the current interest rate. I think it is. Pretty sure it is. Might be 0.5%, but I think it's a quarter. Anyway, that's not the rate we pay, right? The bank gets the money for that, and then the bank turns around and charges us more money because, of course, in case you haven't noticed, banks are a den of thieves. Sorry if anybody or relatives work in a bank. But hopefully you've noticed there's only one type of institution that is a public institution in terms of not being owned by a corporation, and that's credit unions, but they have to keep their doors open as well, so same stuff applies to them. So all this stuff is dependent upon this overnight interest rate. So the bank is going to charge it, in theory, the lower this rate, the lower all of these things are going to be, right? So the bank's going to charge you less interest on your borrowing. So what the Bank of Canada is able to do is able to influence people's spending by lowering interest rates. So the lower the rate, right, it equals an increased spending, especially on large items, like, wow, stop writing so fast, like houses, cars, things like that. So the more they spend, more people will spend, the lower the interest rate. And vice versa, if the interest rate goes up, right, that's going to lower spending. So as you can see here, this was, right, that's the economic downturn, or they call it the Great Recession. This is where the housing bubble burst and everything, the big short and all that kind of stuff. That's where it hit, and so they cut interest rates drastically, as you can see, to try and get it to be, for people not to collapse within their own, by servicing their own debt. So it made it cheaper for people to access money, because if people weren't spending, the economy was going to stall even more. And so they dropped it. Now, they had it down really low, and then they brought it up in Canada anyway. In the United States, it didn't bring it up quite. Usually we are in lockstep with the United States, but theirs was a bit lower. Theirs might even be 0% right now. I think that might be right. But we increased it to lower people's spending as time went on, and then of course you see there's a bit of a downturn again, and then we increased to curb people from spending. So this is what's happened with our interest rate, or overnight interest rate, and so now you know why that interest rate is important and why they have these big they have these big press conferences, is what I meant, to announce the overnight lending rate. Okay, so the targets in terms of monetary policy in Canada, so we're looking at keeping unemployment below 6.5, our growth between 2 and 3%, and our core inflation between 2 and 2.5%. So this one here might, you'd be like, whoa, what's this? Actually, let's go to this one first. This one, you should remember that this is the idea of natural unemployment that we did earlier. Why would you have this? Basically, this is going to, these two things are related, right? So this inflation's the big boogeyman here. If our economy is growing too fast, basically you run out of capacity within your economy, right? Think of the idea of full employment. So if you reach capacity in your economy because you're growing too fast, it's going to cause massive amounts of inflation, or at least that's the theory, and usually it does. So full employment causes inflation because what happens is the resources available become more scarce, and so people are willing to pay more for them. Just think of it in terms of workers. Think if you had a finite amount, well, you do have a finite amount of workers, but think about a small project. You have 100 workers at your disposal. You and another company are competing for the same pool of 100 workers. When things are going well, but not just tearing the roof off, it's okay that there's 100 workers because each of you only needs, say, 40 workers. So there's 20 workers who are unemployed, or that they can come in at any time if you need to boost your workforce by a little bit. Now, let's say that suddenly you have tons more projects and you need more workers, and suddenly you need 60 workers, and suddenly your competitor also needs 60 workers or 50 workers. You only have 100 to draw from, and the demand is at least 110. So that means to entice those 10 workers to go to you instead of the competitor to fulfill your projects, you're going to have to pay them more. And if you increase their pay, they're going to go out and spend more money, so on and so forth, which is going to put pressure on scarce resources out there, like it could be cars or houses, and that puts upward pressure on the price of houses, and that causes inflation because prices are rising. Again, we think about people coming out of Toronto and dense areas with lots of money from selling their house in an area like that, and they come to a cheaper area and they drive up housing prices because they have a lot of money to throw around. So it doesn't matter to them if they overpay for a house because they have a lot of capital built up from selling their other more expensive property in the city. So that, again, that's just that's the same idea in terms of inflation and stuff like that. So in monetary policy, you have the levers of interest rates, right? So higher interest rate fights rising inflation, whereas deflation and the opposite, or low growth rate, you have a lower interest rate to allow people to borrow more and to spend more. On the other side is the whole idea of quantitative easing, which people would have learned from in 2008, 2009, from that economic crisis. But again, that's one of the words that, I don't know how much people actually understand what they're hearing when they hear quantitative easing. I'm going to put down, this is what I mean by how much people actually understand what's going on. So the idea of the money supply, right? The money supply is all of the liquid interest in, not interest, I shouldn't use that word, all the liquid currency that is available in central banks and treasuries in the economy, right? So the money supply is all these things that are cash, deposits, anything that's easily convertible to cash, right? That's a high liquidity or a liquid resource. That's the money supply, right? Your liquid resources, things you can move around to different areas to purchase different things, all that stuff. That's right. That is your money supply. Now, there's such thing called the velocity of money. Sounds awesome. And for mathy people, there's your what's that called? Formula. for the velocity of money, where velocity of money, so VT is velocity of money over a given time frame, so depending on the time frame. So that equals P is price level times the aggregate value, real value of transactions within the same time frame. So that's the transaction value. Aggregate real value, so that means adjusted for inflation, over the nominal amount of money in circulation. Okay, so that's the velocity of money. In case you're wondering, what is that used for? Well, it's used as an indicator of economic growth or lack thereof. It is an indicator of inflation. It is not a statistic that's going to work alone and have it so you that you can rely on it solely. It's just one of the indicators that says that interest rates are getting too high or something like that, right? So that's what that's for. Velocity of money is literally is the idea of the amount of times that currency is used to purchase goods and services in a given time period. Okay, so the amount of money out there, let's say, just give it a random $1 billion, is the money supply at the time. How many times has that $1 billion been used to buy different goods and services within a certain time frame? That is the idea of velocity of money. And again, the concept behind it is it is a useful tool to look at indicators of growth and inflation and things like that. Okay, so this is how people view what's going on right now in the economy, right? That our government is just literally driven down the road, chucking money all over the place, which they are. They actually are, right? Money is very widely available. This is what's been going on in Canada steadily since the 60s or 70s. I think it's the 70s, but I can't quite remember. Another thing I should have looked at, but that's whatever. So it's been going on steadily. Before, people that were alive during the Great Depression didn't spend money they didn't have because they were afraid that things would collapse and they wouldn't have anything. Once things got moving away from the Depression and jobs were plentiful and people were making money, people were willing to spend money on credit, money they didn't have. That has continued in Canada to a point where we are at 158.2%, right? That's the amount of disposable income that's been spent, which basically means if the interest rate were to suddenly go up, right? And it doesn't have to go up that far. We'd have a lot of people that could no longer what's called service their debt. But the interesting thing is, if you drew on the service of debt cost on here, it would actually do this. Because the interest rate has fallen, it's a lot cheaper to service your debt than it was, right? If you look at mortgage rates, they've fallen. If you look at borrowing rates, they're down. All these things are down to encourage people to spend money, which means it's cheaper to borrow money right now. And conversely, it is not investing money unless you're taking bigger risks is not worth it, right? So a bond that's a very secure investment option, it's not going to make you very much money. So instead of saving your money in a savings account or in a bond or something like that you know is not going to fail, it makes more sense in the short run to borrow money to go on vacation. Well, we're not going anywhere, but you know what I mean. Buy a car, put in a pool, do stuff in the back. That's why people did that stuff. They weren't going anywhere. They were spending their money. It was cheaper to do that than to save up your money to do it later, right? Your marginal utility was much higher if you spent money now than before. But it's dangerous if you don't service your debt. And if the interest rate goes up, it means a lot of people could be in trouble. Okay, so just throwing that out there. Interestingly enough, Canada versus the United States has actually fallen in their debt disposable income. Interestingly enough, they have borrowed less money, which is weird considering American consumerism. One thing that has not changed is that U.S. mortgages are still very fragile. Just put that out there. So what I want you to do, so I've been talking about this is all until I get to the money throwing around. This is all classic monetary policy. Monetary theory, I should say. What there is out there now is called modern monetary. Whoa. How many bumps does an M have? Modern monetary theory. MMT, I brought it up before. Okay, this is the time to learn about it. So modern monetary theory in a nutshell says you don't need to worry about inflation. Inflation is when too many dollars are chasing too few products, right? We know that. So that means that inflation is only going to happen when there's too much money circulating. So instead of pulling back on the levers of the interest rate and stuff like that, instead you could use taxes or various forms of taxation to take money out of the economy so that the inflation doesn't grow. So things like you'll hear that employment insurance is actually a tax that we're not paying when people have jobs and things are going well, but we are paying, right, when they don't have jobs. Okay, other way around. When things are going great, you're paying into it, right? So that's a tax, taking money out of your pocket and putting it into basically a savings account for when it isn't good. And when things are not good, we're paying it out, right? So that money is still circulating in the economy. It's just controlling how much of it depending on how well things are going. So you're going to get more of this stuff. So this is what I want you to do, though. I want you to compare classic monetary theory with modern monetary theory. What are the main differences? And which one do you think is more correct? And more correct means which one should we be following, right? And why do you think that? And we're looking at 1 to 2 pages. And of course, cited Chicago, right? Got to clean that up, by the way, the Chicago citation style, right? I put a video out. There's links. Let's clean it up. But 1 to 2 pages, well researched. I really want to know what you think in terms of comparing classic monetary theory with modern monetary theory. We are, as the Canadian government is fully on board with modern monetary theory right now. I'm going to link a podcast again from what's that called? Planet Money and Don't Groan. 23 minutes, but instead of the Freakonomics episode that was 58 minutes. So, thank you to me. So I have that. You're going to have to look stuff up. I will put resources out there as I find some that are not old. But I want you to do your own research, of course, and figure this out, right? Compare the two. Which one do you think? You really listen to the NPR one before to get an idea of what MMT is, and hopefully it's pretty clear when you listen to it. They break it down pretty well. It's at the end you're still going to go, I don't get it. How is that even possible? In a way, you'll be thinking that, and that's okay because that's what a lot of people think. So okay, that is it. I am done for today.